Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my September 24th Energy Update, in which I will explain why, as we are nearing this year's fall shoulder period, the window of opportunity to secure rates before they move higher long-term may be about to close. I focus on natural gas in my videos because it's the largest source of power for the generation of electricity. Therefore, their pricing is highly correlated. In our April 5th Energy Update, we said as we neared this year's spring shoulder period, the window of opportunity at that time to secure rates at their lowest prices of the year would likely close soon. In our April 5th Energy Update, we included this chart in that report. Shortly after writing our April 5th Energy Update, natural gas rallied, anticipating increased demand during the summer, declining as we near this year's fall shoulder. We believe natural gas and electricity prices will again rally, anticipating increased demand in the winter. The short-term pattern of natural gas reaching lows during shoulder periods between the summer cooling and winter heating periods is very common. But the lows reached during this year's shoulder periods might be critical, because we believe natural gas will likely be higher long-term after reaching this year's lows. Now, why do we believe this? We believe this because, as we have explained in previous reports, since 2000, when natural gas declined to where it is in 2024, it always preceded higher prices long-term. The primary reason natural gas was always higher long-term when it was as low as it is this year is prices were unsustainably low. They are unsustainably low when they decline below the cost of production, and producers must respond by making the strategic decision to curtail production to support higher prices, which we fully explained will happen this year in our February 26th Energy Update. Natural gas reached this year's unsustainably low prices due to the very mild 2023-24 winter, resulting in natural gas inventories ending the winter heating season 41% above the 5-year moving average. But as expected, when producers slowed their production, the massive surplus at the end of the winter heating season will virtually be eliminated during this year's summer cooling season. And as we explained in our May 6th Energy Update, although producers' response to low prices was an important factor supporting higher prices, a second factor will impact prices even more long-term. Increased exports of liquefied natural gas, LNG, and increased natural gas pipeline exports to Mexico is projected to move natural gas into supply deficits in 2025 and beyond. To put into perspective how much increased LNG exports overseas and pipeline exports to Mexico will impact our natural gas supplies, the Energy Information Administration, that's the EIA's short-term energy outlook, has forecasted net exports will increase from 13.6 billion cubic feet a day in 2024 to 16.4 billion cubic feet per day in 2025. If the EIA's forecast is correct, the net result will be our net exports would increase more than 1,000 billion cubic feet a day in 2025. And our supply surplus in 2024 will become a supply deficit in 2025. And support higher prices for natural gas not only in 2025, but likely longer term. In a recent report, the EIA revealed North America's liquefied natural gas export capacity is on track to more than double between 2024 and 2028, going from 11.4 billion cubic feet per day in 2023 to 24.4 billion cubic feet per day in 2028. If projects currently under construction begin operations as planned, the EIA says the price increases forecasted for 2025 will reflect the United States natural gas production will not keep pace with growth in liquefied natural gas exports and increased pipeline exports to Mexico. Therefore, they expect the Henry Hub spot price will rise from an average price of $2.20 in 2024 to an average price of $3.10 next year, and this would be an increase of 41%. Our concern here at Energy Professionals is the EIA's estimated higher natural gas prices for 2025 may not be a short-term event, but portend higher prices longer term. A New York Times article that was released earlier this year explained that something unusual is happening in America. Demand for electricity, which has stayed largely flat for 2 decades, has begun to surge, and I quote, "Over the past year, electric utilities have nearly doubled their forecast for how much additional power they'll need by 2028, as they expect to confront an unexpected explosion in the number of data centers, an abrupt resurgence in manufacturing driven by new federal laws, and millions of electric vehicles now going to be plugged in." Now, many power companies are already struggling to keep the lights on, especially during extreme weather, and they say the strain on grids will only increase. Further evidence the New York Times concerns are coming to pass was on July 30th, the PJM announced the results of their 2025-2026 base residual auction. Their report revealed that the cost of capacity will increase in most zones from $28.92 to $269.92, which will increase the cost of electricity by more than 2 cents per kilowatt hour starting in June 2025. Capacity is the second largest component of the cost of electricity, but as we explained in previous reports, you can keep your costs as low as possible by reserving long-term agreements, while the largest component of the cost of electricity is near its lowest price since 2000. Potential supply-demand imbalances that are forecasted through 2028 increase the risk of higher prices. Therefore, we recommend anyone with natural gas and electricity agreements expiring through 2025 reserve power long-term to be available when their present agreements expire. We realize our clients' risk tolerance and hedging strategies are not all the same, but hopefully today's report will help put into perspective your risk-reward opportunities. And we invite you to call one of our energy analysts to help you plan a hedging strategy that would be appropriate for your situation. And until my next report, please take care.